Hello, hello. Let me see. There it is. All right. Hello, hello, hello. Let me quickly send it out to everyone as well. All right. Hello, hello. Good morning. Good afternoon. Good evening. Thank you, Ryan. Thank you, thank you, thank you. Hello, Stanley. I'm doing great. Thank you. How are you? Hello, John from Brooklyn, New York. Very nice. Hello, hello, hello. For sure, mindset. For sure, for sure. That's all right. Hello, Ismail. Hello, hello. Hello, Ivan. Hello, Tommy. How's everyone doing? Smile, I'm smiling. Hello, Jesko. Hello, hello, hello. From Poland. Love to see it, Robert. Love to see it. No sound. You can hear me or no? Can everyone hear me? Can everyone see me? For a double check. Check, check, check. I believe everyone should be able to hear me and see me. Perfect. Sound perfect. Video perfect. Perfect. Okay, thank you. Thank you, thank you, thank you. Love to hear it, Rupa. Love to hear it. Love to hear it. All right, nice. Nice. Thank you, Damien. Thank you. Hello, Esbjörn. Hello, hello, hello. I'm doing good. Thank you. I'm doing good. Thank you, thank you. So today I actually wanted to go over something interesting. I wanted to go over a few areas of opportunities actually. This is something I've been working on a little bit to understand better where people do want to look for a trade ID. And that's what I like to call an area of opportunity. So an area of opportunity is essentially, again, where you start looking for your trade ID. So where you start looking for your narrative, your entry eventually, etc., etc. A little bit different than a context area. We're going to dive into that as well. Hello, hello. Hello from Anya, Germany. Love to see it. Nice, 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 nice. Thank you, PD. Thank you, thank you, thank you. Thank you, thank you. Perfect. It depends. It depends, Matt. Is Turtle Soup 4 hour, 15-minute a good strategy? There's of course a lot more going into that, but as a core, that can be all right. That can be all right, for sure. Perfect. On MT, I read trading plan module. On masterclass, what it means, the trading plan module that we have in the masterclass is where I created a complete new trading plan from scratch. I took a live account and I made that trading plan profitable on a live account. Essentially, that's it. So it's essentially how you go from having knowledge to picking something that resonates with you, how to turn it into a trading plan, and how you overcome those problems that you have in your trading plan. Essentially, that's it. Was very valuable for the people in the MMT. But do people often blow accounts after passing a prop firm challenge? I think it really comes down to risk management. Risk management usually goes hand in hand with psychology as well. It's usually a mix of both, because if you can't keep your psychology in check, then your risk management is also thrown out the window, and then usually start to risk a whole lot more. Yeah, it's difficult. Difficult. For sure, Peter. 100%. 100%. For sure. And again, the reason why I say risk management, not necessarily something else, is because it's quite hard to blow an account if you have proper risk management. If you have boundaries in place of dropping in risk and increasing risk, etc., etc. What about tariff war? Well, the tariff war is noticeable in the market at this moment in time, but it's mainly noticeable and through a lot of volatility, a lot more unexpected volatility at, and what I mean unexpected, at unexpected times, which is quite interesting as well. I think my sound is as usual, so if your sound is quite low, I'm not sure if it's on my end, but I'm not sure if you can put it. I'll try to talk louder. But the tariff war is really noticeable through the volatility that we have in the market. A lot of volatility. Yes, Ivan. Did you take a trade this week? Gold looked interesting. Well, you said it there. I took a good trade on gold this past week. I took a trade on gold. You look sad today. I look sad today. I'm not sad today. I'm not sad. I'm not sad. Hello, Amir. Hello. All right, let's dive into it. So first of all, I want to go over the forecast. Then afterwards, well, no, actually other way around. First of all, I want to go over what this live stream is mainly about as well, is spotting the opportunities of the past week, because I believe there were quite a few opportunities that we had in the past week. And also then diving a little bit into the area of opportunities. And then afterwards, we'll build onto that through the forecast as well. Let's first take a look right here, what we have in the economic calendar. So this next upcoming economic calendar right here for the next week is overall quite interesting. There's not necessarily anything standing out. Now we do have some bank holidays right there towards the end of the week right there, but overall it looks like an okay week. Again, like I mentioned already, we have a lot more unexpected volatility nowadays than we used to have before Trump presidency, essentially, where it was more predictable. For example, CPI is going to bring volatility, and NFP is going to bring volatility, FOMC statement, etc. The big three. Now, nowadays, at this moment in time at least, I'm not expecting this to continue forever, but it will continue for a while at least. We have a lot more unexpected volatility. So the market is quite volatile in general. So for example, what you'll see on a NASDAQ is where even the London session is also quite interesting to trade because the increase in overall volatility. This is something to take into account, something to essentially profit from, I would say. Because increase in volatility, of course, we need to find somewhat of a balance. Too much increase in volatility is not necessarily good, but a lack of volatility is also not good. But when there's a decent amount of volatility, consistent volatility, that's nice. So if we then take a look at the market right here. So if we break down last week, it's been quite interesting. We have reached this yearly fair value gap right there as well, but we'll dive into that in just a little bit. First, let's understand what we are looking at right here. We mentioned, if we go all the way back right here, we mentioned we have this weekly fair value gap right there. From that weekly fair value gap, we can now see two candle rejection, which is where we see this candle right here sweep the previous candle high right there to then continue lower potentially, where we mentioned eventually this candle should now be an expansion phase candle to overall continue lower. Okay, that also played out nicely. Then last week right here, we mentioned, okay, now it becomes overall tricky. I would say still bearish, but it becomes a little bit more tricky because we have a lot of momentum coming into the market right here. A lot of bullish momentum coming into the market, which is important to understand. And the reason why that is important to understand, because that's a disturbance in momentum. We're going to have a separate video on that as well, momentum theory. We're going to dive fully into that as well. But that is important to understand. So if we go into the daily right here, then what did we discuss? Well, we have this daily fair value gap right here. And then we also have this fair value area right there towards the left. Referring back to a video that I made, market structure plus liquidity, something along those lines. If we are going to offer fair value and simply going to continue lower, something like this will happen. Staying back into the fair value area right there to continue lower. If we are going to continue higher, then something like this will happen, where we first reject from the fair value area, tried to offer fair value, failed to do so. So instead start to run the high right there towards the left. And then we start to target the liquidity at the top right there. Okay? It's important to understand because that gives you essentially two options right there, quite objectively. So if we go into the lower time frame right here, and we go into the 4 hour, then what do we see? We see eventually right there, we have this thing into the fair value gap and into the fair value area. Okay, we start to create a bearish 4 hour fair value gap right there. Now, to me, that first 4 hour fair value gap was not necessarily that interesting. Why? We'll touch on this a little bit more as well in the momentum theory video. It's already recorded. It's currently just in the edit. I hope it makes it out very soon. But the reason why is because at this first stage, we can potentially see a consolidation. And that's purely seen through the disturbance in momentum right there that we have right there as well. Because there's a lot of bullish momentum coming into a bearish momentum market. That's important to understand. So right here, we now have two areas of opportunities. And what are those? Those are the following. If we are going to seek this liquidity at the top right here, then we are going to run this rejection high. And if we run that rejection high, and I read a book the other day, and the book says that people like to generalize or essentially make a summary of what someone is saying. But I think it's quite important to understand the exact words that someone is using and to fully understand that to its core. That's how I like to make videos as well. I like to break down the words, the sentences that we use fully at its core, because I think that's quite important to understand. We are going to run this rejection high. Why is that a rejection high? Because it's a 2-candle rejection high right there. And we are going to run it. We're not going to sweep it, meaning we are going to be comfortable above that high right there. Not a sweep like this. Perfect. So this right here, if we run that high, we are going to have this area of opportunity. What is this area of opportunity? So this area of opportunity, that's something I want to touch on a little bit more in the new module when in the MMT, and also maybe a little bit in the YouTube series as well. But the area of opportunities, essentially, remember how we have the 5 foundational levels. So we have number 1, bias. We have number 2, narrative. Then we have number 3, context. So the context area right there. Then number 4, we have the entry. And number 5 is risk management right there. Now, the context area right there, when we have a context area, which you'll see in the video that I uploaded this weekend, yesterday as well, the context area tells you where to look for an entry right there. Now, the area of opportunity right here tells you where to start looking for your narrative area right there. So you could essentially say this is 1.5 right there, foundational level right there. Because this tells you when to start looking for your narrative and context area, when it's very likely, very high probability that we are going to reach these further targets right there, if that makes sense. So at this moment in time, if you were trading here in the middle right there, it's not where you want to trade. You want to trade either if we run this low, which creates a new area of opportunity right here towards these next lows right there as well, or you want to trade if we run this high right there. But do not get caught in the middle right there. Because if you get caught in the middle, you're most likely going to get caught in a consolidation, which is not what we want, ideally, of course. So what happens eventually is the following right here. And we start to run this low right here. And when we start to run this low right here, that gives us a new 4-hour fair value gap essentially to work with right there. That we in the short term can continue lower from. Now, that's also what we saw. I believe some people even caught this trade idea as well from the 50-minute. It was just a simple context area, right? There's a 4-hour context right here towards this low right there. And we can continue lower from that right there as well. Now, there's something specifically that we mentioned in the entry video actually yesterday. And that was, if your context is gone, you don't want to look for a new trade ID. So this is the context low. And the reason why those context lows are so important is the following. Is because at the moment in time where we are going to continue lower from this fair value gap right here, then even if the market is going to continue higher, so I need you to understand this very clearly. Even if the market is going to continue higher, it at first will still continue lower. Why? Because the market is very unlikely that it's just going to straight up, straight down, straight up, straight down. No, it needs some liquidity to move towards the other side of the market. Which means that right here, if we are going to continue higher, it will first use the context low right there to sweep it for liquidity purposes, to then push higher from it right there, if that makes sense. And that is important to understand, because then when we have the 4-hour fair value gap that pushes price lower, at this moment in time, if we are going to continue lower, we're going to continue lower from the 4-hour fair value gap towards this low. If we are going to continue higher, we're also likely to continue lower first, to then continue higher from the context low. Now, once we sweep, so that's essentially one option. One option is that we are going to reach the context low. It's the highest probability thing for price to do right there. Once we reach the context low right there, we go from one option to multiple options, because we can either consolidate, we can potentially continue lower already, or we can sweep it to continue higher instead. So we go to 3 options. Now, the more options you have, the lower probability it is. Again, if you have to choose from 33%, 33%, or 33%, it becomes very low probability, because there's not one thing that really stands out on what can happen. That's just probabilities at its core. But right here, then this right there, that move, once we start to sweep this low, you want to take a step back. I'm going to make a video on this as well, but essentially what is very important to understand is in trending conditions right here, you take trades as long as the market agrees with your overall ID. But as long as you create, or if we now create this argument against our trade ID, this is a bullish argument because we are sweeping to potentially continue higher right there. You now want to take a step back right here. You don't want to do anything. Now, people that are quite new to fair value gaps, they might see this bullish fair value gap and might say, oh, wow, that's absolutely beautiful. This bullish 4-hour value gap right there to continue higher overall, beautiful. Fair value gaps are a lot more nuanced than that. It's not just black and white, buy or sell this fair value gap, if that makes sense. So the area of opportunity that we mentioned right here is still above this high, because this is the rejection high from the daily fair value gap that we have towards the left and the daily fair value area that we have towards the left. So as long as we are below this rejection high, we are still potentially rejecting from the fair value gap and fair value area that we have towards the left right there. That's important to understand, because only if we take out this rejection high and we run it right there, only then have we fully disrespected the fair value gap towards the left and the fair value area. So in the meantime, if we want to still look for shorts, at this moment in time, it's also not interesting. So what should happen if we now want to start looking for shorts? Again, I also need you to understand, because I saw a few things here and there. This is broken down live. And the reason why we can break it down live is because everything that I mentioned right here is completely objective. I've not mentioned a thing so far that has been subjective. So every single sentence, and the reason why I mentioned, I believe the details, the devil's in the details, because every detail that I mention is in the way the sentence are structured. The words I use, you can break them down objectively. That's quite important to understand. But we're going to touch on that a lot more as well, so no worries. Now, if we are going to continue lower, what should happen right here? We should take away this bullish argument, which is that bullish fair value gap right there. How do we take away that bullish argument? We take it away by it being disrespected. How is a bullish fair value gap or a fair value gap in general disrespected? It's when we run the rejection of that PD, of that fair value gap. So the same way, if we run this rejection high right there, we are disrespecting this fair value gap. The same what we're going to look at right here. So if we go into the 1 hour right here, then in the 1 hour, we have the 2 candle rejection low right there. First candle, even the second candle, not necessarily rejection right there, but that makes this the rejection low right there based on 2 candle rejection again. Okay, perfect. If we run that low right here, which we do at that moment in time, we now run into this fair value area. What is, again, the same thing. So it's a constant, the cycles repeat essentially. It's the same concepts over and over and over and over. What we were also looking at on the daily right here, we're going to look at the same thing. Okay, well, what if we are going to continue higher? We might offer fair value at the fair value area, which is going to be seen through 2 candle rejection right there. So the first candle is already a rejection right there, to then potentially continue higher. If that's not the case, we are going to offer this fair value. We are going to fail to continue higher right there. Instead, we are going to run the rejection low right here to then already continue lower. And then we have, as what we call in the MMT, a no resistance run, because there's no PD raise, no resistance anymore, withholding us from stopping price to continue lower, essentially. Okay, so what have we just done? We have this area of opportunity, but we now also have this new area of opportunity where we know if we run this low right there, we have this new area of opportunity to overall continue lower towards these lows right there as well. Let's see what happens. Okay, we have another rejection right there, perfectly fine. And eventually, boom, there it is. We start running this low right there. This is the exact moment when an alert should go off on your trading view. And you should, right there, look at the majors or something correlated right there where you start looking for longs, which we're going to dive into as well. I'm going to give you some opportunities right there. But that is exactly where there's now an area of opportunity to overall continue lower right there. Because what have we just done? We have taken away any bullish argument that might have pushed price higher. And again, what is price essentially being high probability? It's when arguments are only for one side of the market and there's no opposing arguments towards the other side of the market. That makes something high probability. That's important to understand. So right here, that gave us essentially a beautiful opportunity right there to continue lower. Again, the way that is reflected, we're going to dive into in EU specifically as well to understand a little bit better, hey, what are we looking at, etc., etc. And eventually we just dropped off. And that brings us right here towards the yearly fair value gap. So I believe at the beginning of the year, we've mentioned the yearly fair value gap right there. But other than that, not really. Again, it's a yearly time frame, so you don't necessarily need to look at it every other week. We've now reached the yearly fair value gap right there. It will be interesting to see what we can do. It is important to understand we are now running into resistance, a yearly resistance even. So the chance that we might create a rejection, the chance that we will struggle a little bit here and there, that's important to understand. So this is not necessarily a week where I would say, well, I'm very excited to get involved or anything like that. If we are going to get confirmation to continue higher, just know confirmation always takes a lot longer than what you expect it to take. So if you think confirmation, if you're behind your desk and you think, oh wow, I need to be ready right here because the confirmation is around the corner, it usually takes another hour, another day, another week before you get the proper confirmation of something. So if we are going to continue higher from a yearly fair value gap right there, most likely you bet it's going to take a while before we get the proper confirmation to continue higher right there, which will be seen through daily fair value gaps mainly as well. So daily fair value gaps right here will tell us if we still want to continue lower the same way we did with the previous daily fair value gap right there last week or this previous week. We expect it to continue lower. If we keep on doing that, perfectly fine, we can continue lower. But if we start to disrespect those fair value gaps, start to run the rejection highs, we want to start looking at higher prices overall, if that makes sense. Okay, so right here, the dollar, I would like to take a step back. I want to see what we want to do right there, but most of the time, just be on the sidelines at this moment in time, at least. Okay, let me first go over the majors before I dive into the indices as well. So at the beginning of last week, we determined, okay, if the dollar is going to continue higher, so let's say it's going to reach that liquidity right there, then the most interesting pairs that you might want to trade are, for example, an Australian dollar, US dollar, because this is very weak right there. New Zealand dollar, US dollar is also quite interesting because this is also very weak right there. And if the dollar is simply going to keep on continuing lower right here, then the pair that you want to trade for the majors is something like an EU right here. Why? Because EU was the strongest. If you compare EU to a GU right here, GU was weak, created a lot of bearish fair value gaps right there. EU didn't do that. So if we break down EU right here, you had this 4-hour fair value gap, which was also the 4-hour fair value gap that we saw on the dollar, which gave some interesting opportunities right there to overall continue higher. After that, struggled a little bit here and there. But on this Thursday, actually, during the live session that we had in the MMT, we saw this right here, which was quite beautiful. We had this fair value area right there, sting into the overlapping fair value gap as well. We perfectly respect that, even on the lower time frame. So if we go into the 5 minute, if we go into the 1 minute, there were a few opportunities right there, right there, to overall continue higher and to keep on targeting these highs right there as well. So you might say, well, why the 50-minute at that moment in time? Is because time and price were simply aligned. And what I mean by that is it was not very likely that price was going to create a consolidation until we reach these next highs right there. Why? We have some major liquidity right here towards the left. So when we reach that major liquidity towards the left, that's where price will slow down, where it will consolidate for a while, sting back into those higher time fair value gaps. But here, CPI was behind us, PPI was still coming up as well. The volatility was ready to push price higher right there, which was seen through 50-minute right there, also respecting the fair value gaps, fair value areas towards the left already. To overall continue higher right there was overall beautiful. Beautiful to see right there. We'll get into my own trade that I took on gold a little bit later on as well. So right here, if the dollar is going to keep on continuing lower, again, to me, EU right here is still very interesting than to keep on continuing higher. The important thing to understand is that EU and quite a few majors have reached major liquidity. What is major liquidity? Major liquidity is an intermediate high or an intermediate low market structure, essentially. And major liquidity is where price is very likely to stop for a while. This is, of course, relatively seen depending on the time frame that you are looking at. For example, now we're looking at the weekly time frame and the weekly intermediate high. So here, the third candle has a whole lot of reasons to potentially consolidate right there. And that's important to understand, because when we do see that consolidation, we now, the week after, so not next week, but the week after, we have a perfect fair value gap right there to continue higher from it eventually. That's something to take into account right there as well. Again, lines up with the idea that we have also reached a yearly fair value gap on the dollar right there. If you missed the previous opportunities that we had right there to continue lower, quite frankly, you just missed the boat. Essentially, that's as simple as it gets. So don't try to force your ID right now still to continue lower, because we're running into quite some heavy resistance overall. So you might just want to take a step back, see why you missed the previous moves, maybe break down these live streams that we're doing, because we broke it down fully, essentially, and then see how you can get involved next time for the next good opportunity. But don't force your ID right now to go short again on the dollar, if that makes sense. Keep an open mind. All right. On the indices right here. The indices, quite interesting actually. If we take a look at ES and NASDAQ mainly, then what we see right here is ES had this sting into this daily fair value gap right there, where it could potentially still simply continue lower. And throughout the week, at the beginning of the week, it did that, essentially. And eventually we overtook right there this 4-hour fair value gap, which caused us to continue higher instead. Now it's this battle, and you'll see this more clearly on NASDAQ. It's this battle between this daily fair value area and this 4-hour fair value area right here. That's perfectly fine, because that creates two areas of opportunities right here. We have this rejection high right here at the top. And we also have this rejection low right here from the 4-hour fair value area, at the bottom right there. So either we are going to run this low right here to simply keep on continuing lower, perfectly fine. Then we can target these lows towards the left right there. If we run this low, so again, run the low, not sweep the low. Very important to understand. It's a major difference. Or if we run this high right here towards these next highs. If we start to run the high right there, and that actually could be quite interesting in my opinion, because if we start to run the high right here, then I don't want to talk too soon, but the path towards all-time highs becomes quite clear again. And that could be very interesting overall. So if we zoom out, for example, on the monthly time frame right here, on the monthly time frame, this, to me at least, it seems like nothing more than a retracement that we are currently looking at to simply continue higher again. So I saw the other day, believe it or not, I was on LinkedIn, and I saw someone mention now officially the bear market has started for the indices right there, or for the S&P 500 specifically. And it could be, of course. I'm not sure if I necessarily agree to that as well, because I don't necessarily think this is the start of something bigger. I more so think this is just a heavy manipulation right there to simply continue higher again. That's the way I see it. I could be very wrong, and if I'm wrong, I'm willing to accept that as well. But there's a whole lot of reasons to continue higher at this moment in time, in my opinion. We're sticking into this nested fair value area. We're sweeping a lot of liquidity. Look at the long respect candle that we have right here, the long wick at the bottom right there. We are now potentially starting to disrespect, and that will be the real sign, the real giveaway, is if we do take out this high right there and we start to run these rejection highs right there, create new bullish fair value gaps. Yeah, to me, that looks very likely that we are going to reach new all-time highs. But again, still overall quite early to say that. So the area of opportunities are above this high right here and below this low right here as well. In the meantime, everything that happens right here in the middle, don't want to get involved. I would like to wait. Okay, and that's essentially the same for ES right here. This high, this high right here and this low. Either we run the high, we run the low. In the meantime, I wait. And specifically run the high or run the low. Not a sweep, we run it. Very important to understand. So for example, with this high right here, this is a sweep right there. We're wicking it right there and immediately reversing. Now this right here, this is a run where we are comfortable above the high right there as well. It's important to understand. Okay, YM right here, so US 30, essentially the exact same thing as well. DAX, essentially also the exact same thing right there. So it will be quite interesting to see what we can do though. Right here on the majors, like I mentioned already, I don't necessarily want to look, to look to get involved. There's a beautiful saying in Dutch, but that you're just on the sidelines, you're just watching right there, and that's exactly what I'm going to do. I'm just going to watch and see what we want to do. I'm specifically going to watch the third candle that we are going to create right here. That third candle going to be a large rejection. It's going to be a new expansion. If it's a new expansion, that is earlier, lost my train of thought right there, but earlier in this live stream, I mentioned when there's multiple options, it makes something lower probability, right? Inherently, that is true. And the reason why is because when there's only really one option that you can choose from, it always makes it higher probability because the others are not very likely to play out. So when there's multiple options, it makes something lower probability. So the reason why a third candle is low probability is because there's 3 options that can happen. And arguably only one of those options is high probability. So you have somewhat, if we say it's static percentages, it would be 33% that you're going to have a high probability week next week on EU, for example. That's just static percentages. Now, and that high probability thing is, in general, for most people, is that we are going to create a new breakaway gap. So that this right here is not going to become a fair value gap. Well, it is, but it's going to be a breakaway gap. So a fair value gap that we don't expect a retracement back into, which means that we should see a new expansion right here. How likely is that expansion? You tell me. So right here, in order to see that expansion, we should now run this previous week high right there. If we run the previous week high right there, we can potentially look to trade it. So what is the run? The run could be that we first try to climb above it right there. We might get a rejection. In the second time we climb above it right there and we create those fair value gaps above it right there, we could argue that we are running it at that moment in time. If that's the case, we can start looking at targets towards the left. So let's see where we are. We have this previous week high. So then we could start looking at, for example, don't want to trade it, that high right there. And we can start looking at these next targets that we have. For example, this fair value area that we have right there, etc. And that's the next areas that we could potentially reject from right there, if that makes sense. That's something to pay attention to, because then it creates a brief moment right there of opportunity towards the next resistance area, if that makes sense. And that's important to understand overall. For a GU right here, yes, we can potentially continue higher on GU. I'm not necessarily the biggest fan overall. I do think we can potentially reach those higher right there. But again, with the dollar having reached the yearly fair value gap, I'm not that enthusiastic to look to get involved right here to still continue higher, if that makes sense. So in EU and Australian dollar, US dollar overall, I'm just going to see what we want to do. See what we want to do right there. See if we still want to continue lower, still want to continue higher. And from there, act as well. It's a lot of reacting at that moment in time. That's important to understand. Gold. So I took a trade on gold last week. And the reason why, for example, because some people would say, well, you've been so praising of EU. Why did you take a trade on EU? And why didn't you take a trade on EU? Sorry. And you did on gold is because of the fact that you're never going to get anything more high probability than a pair or an instrument about to reach an all-time high. It's the most, when I talk in a video, I talk about the first thing traders should understand, that daily bias video. I talk about there's going to be a brief moment in price where price and the bias is going to be so stupidly obvious that I could call my mom and she would say, well, Ario, I think it's quite obvious that we are going to continue higher at this moment in time. When that's the case, and the way we break that down is when there's only arguments towards one side of the market, when that is the case, you just want to absolutely capitalize on it, because if you don't, you're going to it's going to come to haunt you. And the reason why is because if you don't capitalize on high probability conditions, you're now going to be a little bit messed up, as in you're going to be like, shit. Now you're going to try to force trade ideas in low probability conditions, and that brings that doom cycle where, because you're not able to capitalize on high probability conditions, you're going to constantly chase those profits, chase that price. So when high probability conditions are there, you just want to do everything in your arsenal to try to get involved, if that makes sense. So that's quite important to understand. Again, take that, of course, with a little bit of grain of salt. Don't risk 10%. Don't do anything crazy, but just within your limits still, right? It's quite important. So on gold right here, we have this weekly fair value gap, weekly fair value area right there that we can potentially continue higher from. At the beginning, and if you watched the forecast last week as well, I wasn't necessarily optimistic, as in, yes, we can potentially continue higher from it, but the momentum that we have coming back into that weekly fair value gap, that threw me off a little bit, as in I didn't like that. It's just yeah, it's a lot of momentum going against us. I don't necessarily like that. Now, what I'm about to show you is a sharp turn at its core, but in the MMT, we really dive a little bit deeper into what makes something high probability, so objectively speaking, and also what makes something very interesting to look to trade. So for example, on YouTube, I mentioned, well, it's a sharp turn, but a sharp turn is a pattern with not a whole lot of thought process behind it. Well, not that I mentioned on YouTube, but in MMT, a sharp turn is a little bit more in depth with a thought process behind it. And what I want to show you right here is an order flow transition. Now, before we see this everywhere on YouTube and the ID, I'm not sure if I should have said it. The ID now starts flowing everywhere right there. But anyway, I'll still break it down right here. When we get this 4-hour fair value gap right there back into, we trade back into that 4-hour value gap and we start to continue lower from right here. This is the context low. We reach that context low. At the moment in time when we reach that context low right there, we sweep it right there, whilst coming back into this 4-hour fair value gap. So what do we have? We now have this bearish fair value gap that we can continue lower from, and we have a potential sweep that we can potentially continue higher from. Why is this a sweep? 2 candle rejection right there, respecting the swing low. So we have both bullish and bearish arguments. Now, when we start to trade back into this 4-hour fair value gap right here, and we do the same that we have done on the dollar as well, this right here is the rejection high from this 4-hour bearish fair value gap. When we run this rejection high, which at first we don't, you see the long wick right there, the sweep, it's not a run. When we start to create this expansion right there, that is a run on that rejection high, which means that this 4-hour fair value gap right there towards the left has been disrespected. So what have we currently seen? An order flow transition to continue higher. So at that moment in time, this fair value gap, for example, is very high probability to continue higher from. Eventually, we create a little bit of a deeper retracement right here. And we have this 4-hour value gap going against us again. On the 1 hour, if you break this down, you'll see the same thing right here. We try to push lower from this 1 hour value gap right there. We sweep this context low, and we then run this rejection high eventually. That's what I like to call an order flow transition. So it's not your typical sharp turn, fair value gap in, fair value gap out, but there's a real story behind that. It's an order flow transition, and that is absolutely beautiful, in my opinion. That's a beautiful price action that we can potentially eventually continue higher right now. And once we start to continue higher, the only thing that was not very clear right here was the narrative area. So I'll show you where I took the trade. The trade was right there. Now, if we dive into this price action at this moment in time, we can either create the retracement back into the 4-hour value gap to then continue higher from it, or we can already create expansions to then continue higher. But there's one thing that is very obvious, and that is that we are going to reach the all-time high right there. But how we are going to get there at that moment in time was a little bit iffy. So are we going to create a retracement? Are we going to expand? Don't worry about it. Just place your alert. Place an alert right here at this moment in time, right there, because at that moment in time, we are most likely expanding. Or place your alert, place your alert right there at the 4-hour value gap. When one of the alert triggers right there, that's your time to act. So right here, the alert triggered when we start to continue higher right here. And then once we continue higher, we go into the 50-minute right here. And this is how you can get quite advanced with your stop loss placement as well, because you'll see my stop loss placement is a bit odd. But why is it there? Because in the worst case scenario right there, if we are now going to all of a sudden create a retracement, how far can we potentially retrace? Assuming that this 4-hour value gap, because we have now had new expansions, is going to become a breakaway gap. So that is not it's not in the conversation anymore. So if we are going to create a retracement, the first we can retrace is back into this fair value area right there to then continue higher from it. So my stop loss right there is in a perfectly fine place. Towards the all-time high right there, targeting a simple 1 to 2 to then continue higher right there. And at this moment in time, it was just an easy ride, let's put it that way, to continue higher. So that was the trade that I had. Overall, I think most of the people here already know my protocol about all-time highs. All-time highs always take a step back until we create large retracements like this. Then it's the time to act again. But when we are at an all-time high right here, we don't necessarily have targets towards the left to work with. Some people would say you can use Fibonacci. Fibonacci to me is too random to be able to predict that accurately as well. So for me, I would rather wait for deep retracements right here to then potentially look to get involved again once we have clear targets towards the left again to work with, if that makes sense. So that's also the protocol at this moment in time for gold. Silver right here. Silver created this bearish fair value gap right there. Again, to us, that was not interesting because we saw what was happening on gold. So silver was not very likely to respect this. And why not trade silver? Because gold is stronger. So if we're going to look for buys right here, pick the stronger pair. Pick gold right there, not silver right there. That's also important to understand. So this right here, at this moment in time, even not necessarily that interesting. Bitcoin. Another day, another consolidation right here. I like to mention on Bitcoin because this simply is just, it's not that interesting at this moment in time. Not to continue higher, not to continue lower. It's just one big consolidation and it's very typical Bitcoin price action. I'm not a big fan of that. So right here, be my guest to do your own analysis because this to me is not necessarily that clear. We can continue higher, can continue lower. I still think we would like to, for example, if we are going to continue higher, reach back into this fair value area right there at 73,000 to then potentially continue higher from it as well. But that's simply waiting because there's nothing really too clear at this moment in time, in my opinion. Okay. Crude oil has created this bearish weekly fair value gap, which is interesting to monitor. Whether we respect it or not, I don't really care. Because if we disrespect it, we could potentially start looking at higher prices right there. But if we respect it, it could be interesting to overall continue lower towards these next lows right there as well. Bank Nifty. Okay, Bank Nifty started off with a large gap towards the downside, which was quite interesting. Back into the fair value area right here on the weekly time frame. This can still continue higher. And what we see right here is interesting. We have this fair value area going against us, the bearish fair value area. We have this rejection high right there. We run the rejection high, which is more visibly seen on the 4-hour right there. And we can now potentially continue higher towards these next targets as well. Looks quite interesting, in my opinion. All right. And that's it. That's it for the forecast. That's it for the breakdown. Feel free to let me know if there's any questions as well. We'll go over a few questions. I'm from the Netherlands. I'm from the Netherlands. You're close though. You're very close. Belgium or Luxembourg, you're close. Yes, this will be saved. This will be saved. You can find any live stream simply on the channel. On the live stream tab right there, and you can watch it back. I am using the TFC right there. That one. That's the one I'm using for the dollar, for the Dixie. How long was I ranting about? A good 45 minutes. Nice. Please define fair value area. Fair value area is the area from an intermediate high to an intermediate low, or an intermediate low to an intermediate high. That's a fair value area. Kill zones are essentially just bursts of volatility, nothing more, nothing less. So when I learned about a kill zone, I thought it was this magic area where, well, magic zone where magic would happen. So it would magically play out or something like that. But throughout the day, you're going to have different bursts of volatility. For example, one that is of course very obvious is 9:30. 9:30 at the equities open, you're going to have a lot of volatility coming into the market, etc., etc. It's equities open. And kill zones are somewhat like that. Now, 9:30 is an extreme example, of course, but like a London kill zone is just an extra burst of volatility that you're going to get. And since there's more volatility in the market, it means, for example, an order block, a fair value gap are more likely to hold in general. You're less likely to see consolidations. If that makes sense. That's essentially a kill zone. GJ, let's see. Let's go over the JPY pairs actually. JPY pairs, it could actually be quite interesting. Before I say anything else, it could be quite interesting right here because if we CHF JPY, by the way, very strong right here. This heading into next week could be quite interesting to see if we can reach this intermediate high right there as well. If we take a look at, well, Euro JPY even right there as well, a GBP JPY or a New Zealand dollar JPY, a little bit in a similar boat. GBP JPY, I would really want to wait until we can potentially reach this high right there. If we run that high, it could potentially be quite interesting to start looking at higher prices right there. But overall, it's a little bit in between. So for example, New Zealand dollar JPY, same. If we run this high right there, could be interesting to target these higher highs right there as well. Same for example, an Australian dollar JPY. But again, if we are looking to trade the strongest one, I would just advise, look at CHF JPY right here. It's very strong. It's very strong. Which is the best strategy? The one that suits you. That's the best one. You can copy my strategy, but you won't be able to make it work. You can copy a strategy of someone who has, take a, I don't know, an FTMO leaderboard trader. And if you copy his strategy, you also won't be able to make it work. It's all about your strategy. It's what suits you. If it was as simple as copying each other's strategies and being profitable, then there would be a whole lot more profitable traders. It's a stick entry, Andrea. It's a little bit different, but it's essentially how I like to enter when price is already running. It's a stick entry, so it's just purely based on candle signs. The reasons for consolidations. That's actually a good question. I like that question. Consolidations can all, I need to be careful what I say, but 9 out of 10 times you can see a consolidation coming. So the reason why, for example, we saw the consolidation coming on the dollar right there at first, at the beginning of the week right there. So here, short-term consolidation is because consolidations happen because of disturbance in momentum. So think of it like this. When the market is going to continue lower quite heavily, and all of a sudden you get this influx of bullish momentum, then both the bearish and bullish side are quite strong, are equally as strong. When you have two sides that are equally as strong, so think of it like a tug of war. When two teams are pulling on a rope, and they're equally as strong, the rope is not going anywhere. It's going to stay in the middle. So that's a consolidation. You're staying in the middle. It's not going anywhere. When one side is stronger than the other, that's when the rope moves. That's exactly when you get trending conditions, etc. When there's one side that is stronger. Now, when there's disturbance in momentum, so here, for example, we have momentum coming into the market right there that tells you there's going to be a consolidation right there. Why? Because the momentum is destroyed. We're going to get more towards 50-50 momentum. 50% momentum towards the bullish side, 50% momentum towards the bearish side. That leads to price consolidating in the short term right there. Because both sides are pulling on the rope right there. That's how you can, if you start to notice that, you can spot consolidations very, very accurately before they happen. Because there's always a sign that leads up to it. And that sign is always going to be disturbance and momentum. Duel says doing good. yeah. Duel is doing good. Thank you for asking. Thank you. Do you think AI will trade better than human trades? Help. Uh, mm, mm, mm. Yes and no. I think, for example, if you take an AI versus a beginner trader, I think the AI will outperform the beginner trader to a certain degree. Yes, but after a while, I think the human will outperform the AI to a certain degree as well. And I mean, I'm talking mainly. I'm not talking about AIs compared to a hedge fund that has AIs, etc., etc., that have billions and millions amount of money to invest into an AI, etc., etc. I'm talking about the average retail trader. And because I think a large part of what it comes down to is also experience. Experience in the market. And I think after a certain moment in time, your brain is essentially a very advanced pattern recognition machine. So eventually your brain starts to pick up on these different signals that the market is giving you. So that's why after a certain level of experience, traders start to all of a sudden increase their win rate, increase their return as well, whilst not necessarily changing a whole lot about their strategies, simply because of experience. So in that regard, I think an AI being completely objective to a certain degree is also not necessarily the best, unless you have millions and billions to invest into an AI and an EA in general and a bot essentially that you can find the smallest detail that can be made objectively. But you're not going to outcompete the hedge funds in that regard. How do you deal with losses? It's a good question as well. I think losses are loss is just important to understand if it was a valid loss for your trading plan. So what I mean by that is if it was a loss not in your trading plan, then it's always a bad loss. But even if it's a winner that's not in your trading plan, it's also a bad winner essentially, right? So that's essentially the first thing you want to look at. Is this a loss and was this an okay loss? And if it's an okay loss, then yeah, be perfectly fine with it. You're following your process. So if you constantly follow the process, again, on a one by one basis, you have a loss. But if you follow the process over hundreds and hundreds of trades, you are profitable. So that's what the process is for. The thing I would like to say, don't look too deep into your losses, I think, because some people really, it drives them crazy to a certain degree where they have to know why something happened or why they took a loss. It's a process. Nothing happens 100% of the time. It's very important to understand. Let's see. Pick your poison. If you use Oanda or CME broker chart, again, pick your poison in that. I don't really mind which one you choose. Usually it's the same as two books that have the same outcome. The story leading up to it might be a little bit different, but the outcome is going to be the same. So for example, if you do have a fair value gap that we had to sting into, but we don't, again, the outcome is going to be very similar. So pick your poison in that. I don't really mind the broker in that sense. I'm not sure if that's the right question to ask. Is how to pass profit from challenges faster. I'm not sure if that's the right question to ask yourself. I think a better question would be how to pass profit from challenges correctly. I think faster is not always better to a certain degree. Faster, I actually made a video about this, or well, I made a video about this. It's still in review, etc., etc. But where I think nowadays people are so focused on on passing prop firms or challenges very fast that it leaves them with a very bad foundation. So if you do start to trade live, your risk management all messed up. You can't withstand a 4% drawdown, for example, because you're just not used to that. It's just a one trade gamble essentially to pass your challenges, etc. So and what that eventually also leads to, even if let's say you do succeed, a prop firm is not going to be able to A-book you. So what happens is the prop firm is eventually going to ban you, and if you do, then you can blame the prop firm, and I can to a certain degree understand it as well. But if that leaves you eventually with no prop firm to trade anymore, you just blew your chance. So then that came at the cost of, because you passed it faster. I don't know. It's a marathon to me, not necessarily a sprint. Yes, Sudeep, I hope to touch on it a little bit in the YouTube series. I do also in a new MMT module. If you're interested in that, feel free to reach out as well. Again, our email is always open for any type of questions, info@ario.io. These are the only 2 emails that we have, so please don't fall for anything else, or check the email very clearly right there. Those are the only 2 emails. Feel free to reach out if you do have any question regarding the MMT or anything like that as well. And yeah. Yeah. There's no coupons, no anything, no discounts, no. The value is very much worth it. We don't need to have discounts. I hope there's going to be videos next week on Wednesday and Saturday. On Wednesday 8:30 and Saturday 8:30 as well. I hope. It's possible to be profitable with trading one indices ES in Forex prop firms, not future prop firms. Yeah, you can, but for example, I used to trade ES and NASDAQ a long time in CFD prop firms, so Forex prop firms. But if you're really only going to focus down on ES, I would advise, why not go for futures prop firms? Feel free to also reach out if there's any billing issues right there. Feel free to reach out. The light, we actually added the zero to hero module. Zero to hero module was the previous large module. The large module where a lot of people succeeded with that one, or liked that one a lot as well. Can you differentiate what we can learn from more in the MMT? MMT is more in depth, first of all. It's broken down more. So where YouTube is more so a bird's eye view and more so top of the iceberg, I like to call it. MMT is really going very narrow. So for example, the MMT is very structured to a sense. You know where to use the concepts. You know how to use the concepts. You know how to turn it into a process, how to turn it into a trading plan. We outline exactly the problems that you're going to run into when you do have your trading plan, etc., etc. So it's a lot more structured in that sense as well. It's, as I like to call it, more so of a fast track. Where YouTube, you're more so left to a certain degree also on your own. Barca or Madrid. I don't really prefer any or the other, to be honest. I don't really have a preference in that. I'm sorry. I used to be more of a Barca fan. But it's not that I'm a die-hard Barca fan or anything like that. I'm just focusing on respecting and disrespecting of fair value helps my train greatly. Love that. It's very nice. That's very nice. All right, team. I'm going to end it here. Thank you, everyone, for being here. Have a great rest of your weekend. If you do have any questions again about the module that's coming up right there, feel free to ask us as well on email or in the Discord or wherever you want. As long as you make sure it's us and you're not talking to some random guy as well, of course. Thank you everyone for being here. I hope again, videos on Wednesday and Saturday, and then also, of course, live stream on Sunday as usual. And then I'll see everyone at the next one as well. Perfect. Thank you, everyone. Thank you. Take care.